Hello, it's Rhonda Thomas, and we're just about to do Personal Finance Chapter 6, Static Problems. So if you want to join me, we'll get started. Okay, so I am going to share my screen. All right, and make sure I have everything. I have the Chapter 6 Static Problems in Connect, and I have my spreadsheet. All right, this okay, hang on just a second. I also am going to open the ebook just in case I need it. I don't think I do, but just in case. We also want the time value of money calculator opened up. So chapter 6 is Introduction to Consumer Credit. So it's sitting there. And I do want to get my calculator and my time value of money tables open. So I forgot to do that, of course. So let me go into Canvas. Okay, and then we'll go to modules. And we'll scroll down to get the time value of money calculator ready to go. There it is. And then we'll also get the time value of money tables, which I've got in every chapter. All right, there we go. Here we have it. So I think we're ready now because we are going to do some time value of money problems in chapter 6. So chapter 6, let me go back, is entitled Introduction to Consumer Credit. There it is. There it is. Okay. So here is our first question. Okay, so consumer credit, different ways of looking at credit with financial institutions or get qualifying for a mortgage or some other kind of loan. All right, so a few years ago, Michael purchased a home for $300,000. Today, it's worth $450,000. He has a remaining mortgage that he owes on it of $150,000. It says, assume Michael can borrow up to 80% of the market value of his home. What is the maximum amount he can borrow? So let's write it down. So he bought the home for $300,000. Let me go back up here just a minute. He bought the home for $300,000. Today's market value is $450,000, and he has a remaining mortgage of $150,000. Well, so let's see. The maximum loan amount is the market value times 80% minus the current loan balance. Okay, so if we take 80% of 450,000, which is the new market value, and we subtract his mortgage balance, here is the maximum loan amount. So borrowing money against a home can oftentimes be a good place because you get a good interest rate because there's collateral behind the loan. Okay, there's collateral. When you can have collateral, something, there's an asset behind the loan in case the loan is defaulted on, the house is there to provide value to somebody if the loan is defaulted. All right, so let's see if we're right. I believe so. Yep. Okay. All right, we're going to do quite a few different ratios in this chapter. There are oftentimes different ratios that banks and financial institutions use to calculate whether you're credit worthy or not, if you're ready for a loan or not. Okay, so the second one, let me go get that here. make it just a little bit smaller. Okay, there we have it. So onward we go. All right, this one that we're going to learn is called the debt payments to income ratio. Debt payments to income ratio. So Louise's monthly gross income is $4,000. I've got that in the spreadsheet here. Okay, just a second. Okay, I'll be right back to you. Okay, so all right, back to this. Okay, Louise's monthly gross salary is $4,000. It says her employer withholds $800 for federal income tax, $320 in Social Security taxes a month, and then Louise contributes $160 a month to her individual retirement account. Okay, so we have to calculate what's called net income or net pay. All right, this is her net pay. And we're going to use that number in the formula. All right, so the formula is the debt payments to income ratio. So if this is her monthly income, now we're going to list her debt for the month. She says she has a Visa, MasterCard, and Discover, and she makes payments of 70, 60, and 40, and her monthly automobile payment is $570. So I have those 4 items here, and they add up to $740. So what we want is the numerator, the denominator, okay, the denominator, the numerator. All right, so we have $740 worth of debt a month divided by a monthly net income. That equals 27.2%. 27.2%. So let's put that number in. They do want a percentage, and they want it to 1 decimal place. Well, the book talks about a recommended high of 20% to have debt to income. So what this is telling us is for every dollar of debt, for every dollar of income that she has 27.2 cents worth of debt. Okay, so that's more than a quarter. Like I said, the book says the ideal amount to stay under is 20%. So according to the book, she's not living within her means. Okay. Now there's no police that are going to come out and tell you that you've got too high of a debt to equity or debt to payments ratio, debt to income ratio. There's nobody going to be policing this, just you. And, but if you want to get more savvy with your finances, there might be a way to try to curb that down below the 20%. Okay, now we're going to do one called debt to equity ratio. So anything you see that's a ratio is going to be a division problem. Okay, so let's go to number 3. Okay, so Robert owns a $280,000 townhouse. Okay, and still has an unpaid mortgage of $220,000. Okay, and so let me make this just a little bit smaller so we can see this. Here we go. All right, so here is Robert's debt. He has the following liabilities. So when we do debt to equity ratio, we are not going to include the mortgage. We're only going to include any other kind of debt that he has. So Visa, MasterCard, Discover, educational loan, personal bank loan, auto loan. So it looks like his loan is $14,820, or debt is $14,820. And then we need to find his net worth. They say his net worth is $42,000. All right, so when you multiply or when you divide the 14,820 by the 42,000, you get a number that's 0.35. Do not convert this to a percentage. There's something about this number that they want it in decimal form, which I guess they should get what they want. So be sure to just put this in as a 0.35. And the book talks about an upper limit of debt obligations of being 1. Okay, so no, 0.35 is not very close to this upper limit here. So has he reached the upper limit of debt obligations? And the answer is no. Okay, he'd have to have quite a bit more debt or quite a bit less net worth to make him get close to 1. Okay, so let's just check our work real quick, make sure we're right. Okay, we're ready for number 4 now. So we're on number 4. Okay, here we are. Kim is deciding whether she can afford a loan she needs in order to go to chiropractic school. Right now, Kim is living at home and works part-time in a shoe store, earning a gross income of $820 a month. Her employer deducts $145,000 for taxes from her monthly pay. She also pays $95 on several credit card debts each month. The loan she needs for chiropractic school will cost an additional $120,000 per month. Help Kim make her decision by calculating her debt payments to income ratio with and without the college loan. And then we're going to try to keep in mind the 20% rule. So once again, the book suggests that when it comes to the debt payments to income, that you not go above 20%. So here's what she has. She has a monthly income of $820. We subtract the taxes withheld to get net income of $675. Here is her current monthly debt for credit cards, right? credit card payments. So before she decides whether or not to accept a loan to chiropractic school, let's see what her debt to income ratio is first. So she's got $95 in debt a month. She gets $675. So if you take the debt and divide by the net income, you get 14.07. Now I'm going to put that down here, 14.07, and it is want a percentage. They do want a percentage. Okay. So now let's do it with the loan, right? With the loan. So we're going to list the loan and the credit cards, and that ends up being debt of each month of $215. Then we have not improved our income for the month. Okay, so here is the denominator. All right, so when we do the math here, we divide the debt by the net income, and it turns out to be 31.85. I'm not real crazy about this question because it doesn't take into account, but let me go ahead and finish here. It doesn't take into account that going to chiropractic school, eventually she'll probably be bringing in more money than a part-time shoe salesperson. Okay, so there's that. And the third option I say is, well, maybe because she lives at home, maybe she could try to pay down those credit cards or not have them and just try to live off of what she makes and then see what the debt to income ratio would be. So here I've got the third option, the loan divided by the net income that she has, and that amount would be under the 20%, but together they're over the 20%. Okay, sometimes you got to go into some debt in order to make more money. So, especially with school. All right, number 5. We're going to wear out these different ratios. So suppose that your monthly net income is $4,800. So I've got that listed here. And then our debt payments, including student loan payment and a gas credit card, total $720. Once again, it's debt payments to income ratio. It's 720 divided by 4,800. And it's 15%. Okay, 15%. So that is less than the 20. Okay, let's go to number 6. How about the same kind of thing? The debt, monthly debt payments. Okay, if your monthly debt payment is $1,368 and your monthly net income is $4,000, then the debt to income ratio is 34.2. Okay, we're checking our work here. Okay, number 7. Drew's monthly net income is $6,000. What is the maximum he should use on debt payments? So $6,000, and they say the max ought to be 20% or less. So his debt payments, he needs to, if he wants to know a number where he should stop, he should try not to have anything more than $1,200 worth of debt a month. Now that's a monthly payment. Okay, so number 8. Okay, number 8. Number 8, the disposable income from your part-time job in 2025 was $12,000. Okay, so let me put 2025 disposable income. Disposable is you have some say over what you do with it. right? So I got 12,000 here. It says you borrowed $500 at 18%. You repaid your loan with interest in 2025. How much would you have available for spending in 2025? So the loan payment, okay, we borrowed it in 2024. Okay, so let's put 2024 here. It was a $500 loan at 18%. $500, which is the principal, times 0.18, which is the interest rate, times 1 year. So the interest on that loan, this is called simple interest, would be $90. Okay, $90. So then we have to subtract. So we add, right? That's the interest. And then the loan amount to be paid back is $500. So if you add those two together, you get $590 that has to be paid back in 2025. So here it is, the repayment of the loan plus interest in 2025 leaves us with $11,410. So they're treating debt like something that has to be paid first, which it should be. It should be paid first before you start spending money. Okay, and you may have to limit your spending for a little while until you get the debt paid off. But, all right, so the amount she has available to spend, when you subtract the interest and the principal payment, you subtract that from 12 grand, you have 11,410. Okay, let's go to number 9. Okay, Carl has a house payment of $1,575 a month, and his car payment is $578 a month. So he's got a mortgage. Whoop, get out of this one. He's got a mortgage that costs him $1,575 a month. His auto costs him $578. So he has loan payments to income ratio. Loan payments. So this is the total of his loan payments, total monthly loan payments. Okay, so we got 2153. Okay, his take home is $4,200. Okay, so here's what I have. His loan payments to income ratio. So we're going to take the total monthly. That's going to be the numerator. And this is going to be the denominator. Okay, so denominator. All right. Okay, and I just want to double check. So yes, this is the numerator, this is the denominator, and we want this to 2 decimal places. So 51.26. So what did we just find? We took any payment that he had. He had a house payment and a car payment. And we took the amount of the payment and we divided it by his take-home pay, right? And it turns out that for every dollar he has of take-home pay, he has 51.26 cents of debt payments. So half of his spending, half of his money, half of his take-home pay goes to those payments. Okay, so, all right, number 10, Carl's house payment. There's that 1575. So let me make this equal to that. All right, and right, once again, his take-home pay is 4,200. So let me see where I've got this. I've got the house payment as the numerator. And there's the denominator up here again. So we have $1,575 divided by $4,200. Okay, so it turns out that the loan payment of just the house, okay, how much of his take-home pay is his house? His take-home pay, the payment of his house is 37.5 of his take-home pay. You say, well, what is the suggested amount? You'd have to look it up in the book, right? So we're in chapter 6, and I don't happen to have my book with me right this minute, but I do have the ebook. Let's see if they have a recommended amount for let me look here. Can you afford a loan? Debt payments to income, co-signing, building and maintaining your credit rating. So they definitely talk about this debt to equity ratio, but this is income. So hang on a minute. Let me see what I can find here. Let me go back. Okay, so applying for credit. Just a minute. Measuring your credit capacity. Okay. Experts suggest that you spend no more than 20% of your on consumer credit payments. Well, these are this is a house and a car. So that is not consumer credit. Okay, if you look at this, you can see more things that are considered consumer credit. Okay. Okay, I can honestly say that I did not see any limits or suggested percentages about how much a house payment would be compared to income, but it is still important information to know how to figure that. So we're going to go to 11 now, and now we're just going to look at the auto payment. So his auto payment is $578. Okay, let me put that in here, $578. All right, and when you do this as the numerator and the denominator is still $4,200, then you get 13.76%. Okay, there you go. All right, that's it for chapter 6. Okay, we're going to stop the share and say goodbye. So we'll be back for chapter 7's static problems. Hang in there.